Welcome to the Jones Point Navigator Series podcast, where we bring together thought leaders and companies at the crossroads of healthcare, policy, markets, and innovation. Today's guest is Richard Chan, founder of CoverRight, an innovative tool that's helping seniors navigate Medicare Advantage benefits. We discussed the recently finalized Medicare Advantage regulations, the potential impact on the marketing of plans, and the availability of supplemental benefits, and got some of Richard's thoughts on how CMS can better foster innovation in the Medicare Advantage program.
Something that no longer exists, there's probably various reasons for that on the CFPB side, is, at some point the regulator there was basically working closely with innovation and had the sandbox that they were working with startups to allow them to test different types of disclosure to make it easier for consumers to understand. I think that's actually really an interesting idea. Today, the way the regulation works, it's actually very onerous for a startup to get in there and actually do the marketing, get the marketing compliance, just because of all the layers that keep getting added on every single year, and it changes. And one year you have to do this disclaimer, next year you have to do this disclaimer. I think all of that stuff is great, but ultimately sometimes doesn't actually get to the crux of the problem, which is the topic itself is hard to understand. And so you need sort of some to foster some innovation and allow for some new players to come in and go, okay, how do we do this in obviously a regulated manner?
This is the Jones Point Navigator Series podcast. Last year, 51% of eligible seniors were enrolled in a Medicare Advantage plan. It's a program that allows private insurers to offer Medicare benefits. Given its size and growth, Medicare Advantage has attracted interest from large managed care players, as well as startups looking to bring innovation to plan selection and the beneficiary experience. Earlier this month, CMS finalized several regulations governing both Medicare payments and how the plans are paid, as well as how they're marketed to seniors. So what happens when startups focused on the enrollment and beneficiary experience come head-to-head with ongoing Medicare regulations and change in the policy landscape? That's what we're going to talk about today with Richard Chan, founder of CoverRight. Richard, welcome to the Navigator Series podcast.
Thanks, Tommy. Great to be here.
Happy to have you. We always like to start these conversations with a segment we call What's in a Name. Gives us a chance to talk about the name CoverRight, how you came up with it, the brand, and what it means for your customers and clients.
Yeah. Well, thanks for the opportunity to chat about that. CoverRight really came out of two sort of insights that I had. My background has always been in financial services and insurance and fintech, and being an Australian coming to the US, the first time I got here, I just kind of realized how complex the US health insurance and health system was. And I remember getting my first surprise bill on a health procedure where within the first 4 months of arriving, and I was someone who sort of covered insurance as an industry in a prior career for 4 or 5 years globally, and I couldn't fathom how it worked and how anyone could understand how any of this works. And so that kind of set me down this path of how do you help people find the right coverage? How do you help people improve sort of transparency of like health costs and health cost navigation? And that was kind of paired with this kind of experience I'd had around fintech. Prior to CoverRight, I was working with one of the largest student loan refinancing marketplaces, and so was fortunate enough to kind of work within this space on the other end of the demographic spectrum. But the thing that stood out to me mostly is that there's a huge older adult demographic in the US that really isn't serviced by technology entrepreneurs. It's a different type of person that's aging in today. The person who's 65 today has been digitally integrated for most of their careers. They've been working, and I think they face a different set of issues. First generation to be on 401ks versus pensions. First generation to really face 2x health cost inflation versus US inflation, and really the first generation to genuinely think about longevity as a problem. If you ask the average retiree today, it's another 29 years that they expect to live after they retire. And so CoverRight really came about through, how do we help this demographic, firstly find the right health insurance and then and manage the health costs, and then follow them through that journey and help them manage other topics that might come up that are relevant to them as part of this retirement journey they have to go through.
No, that's great, and we appreciate the outside perspective, and hopefully it's not too confusing coming from Australia. So one of the theses and themes a lot of people talk about is that intersection of fintech and healthcare. Can you talk a bit about how your background in fintech has been helpful as you've built this business?
Yeah, I think both the perspective of coming from fintech, which has really, if you think about, a lot of people talk about consumerization of healthcare. What does that really mean? It really means empowering consumers to have the most choice. And if you think about which industry probably in the US has the most choice available to them from one of these regulated spaces, it's probably fintech. A lot of credit card players, a lot of lending players. And so it's interesting coming from that world, particularly for our demographic, the intersection of digital health and finance is very closely tied. As you get older, both of those things become more relevant to each other, particularly as you think about the cost of healthcare as a percentage of your total expenses. And so to come from the world of fintech actually allows us to take a different perspective to what we have seen where, entrepreneurs or people who've been in the health world have a very different perspective of how the consumer interacts with their product or how they want to make a decision, which is very tied to this kind of legacy view of how the whole health industry works. When we've sort of built our platform, we've always built it from, particularly on this Medicare decision that we help people with, how do we make it so that they're empowered? How do we give them the tools to do what they need to do? And how do we treat them like we would any other fintech customer? And most people shop Medicare as if they're shopping a financial product versus shopping a health product, which I think most people think is the case. It's just not. They kind of shop it as an insurance product, truly.
And that's a great insight, Richard, because I think, in finance and fintech, as you know, there's so much time and energy devoted to the customer experience and a customer journey, whether you're going through a credit card or a loan process. And I think that is coming to healthcare, but certainly not as fast as some would like as we get to more of a consumer facing healthcare market. So I definitely see the parallels there and appreciate that, because you're right, as this generation is buying and shopping for Medicare Advantage plans and the drug plans, it is about that customer experience and whether it's good and how that affects their decisions. So it's a really interesting parallel. So let's talk a bit about CoverRight. So focused on Medicare Advantage and the drug plans as well, but love to hear about kind of the depth and breadth of the offering.
Yeah, so CoverRight was built as this first product that we wanted to have with a customer where it would allow us to build the relationship. So we had sort of seen the market and the existing solutions out there and kind of looked at it and said, hey, a lot of it doesn't really empower the consumer. And so we wanted to build an experience that really eliminates the pain point for people making this decision, particularly those making it for the first time. And so the easiest way to talk about our platform is think of it like TurboTax for Medicare. Our goal is to help someone through sort of a digital first experience navigate this decision, provide them the tools to do that. So we have video-based learning tools. We have drug cost visualization tools that allow people to see what costs look like throughout a whole year as they move through the various phases of the drug plans. We have the ability to centralize doctor search, which is obviously very important as you think about networks. And most importantly, we have our own algorithms that help people through this decision tree of whether they should be on Medicare Advantage or supplement. So we do both, and we're agnostic to both. And ultimately, our goal is to do two things. One, help this customer make the right decision. Two, leverage the trust that we've built with this customer to, over time, help them either activate more health benefits based on the information that we do have from this customer, or recommend them other things that are related to them. The nice thing about Medicare is, it's a brand new relationship for us. Most people don't have a Medicare advisor before they're 65. So we get a really beautiful opportunity to build a trusted relationship, then leverage some of the data that we have to really help start nudging them in the right direction. So we think of it a little bit like Credit Karma, what they've done for the millennial market.
Very cool. And you mentioned this, but you're working on both, we'll call it the traditional Medicare benefits as well as the drug benefit as well.
Yep, we do supplement Advantage as well as standalone drug plans.
And I suspect the drug part is a little more complicated for folks. So how have you built the business to meet what is sometimes highly personalized kind of choices and decision factors around the drug coverage?
Yeah, I mean, a lot of it comes down to making sure that people understand what that looks like throughout the year. So I think many people don't realize that there's 4 stages to every drug plan, particularly if you have expensive drugs, that the co-pays for those drugs aren't flat throughout the year. And so our goal really is to surface that. We've built visualization tools, think of it like graphs that allow people to actually check what it looks like over the full year period. as well as the specific breakdown to that. And that's really powerful for a few reasons. One, it makes it easy for people to compare across different plans. And what we've seen, even for, like a drug like Jardiance, which is very popular for diabetes, in the same zip code, across major carriers, that could be anywhere between $150 to $200 difference a month for selecting one carrier versus the other. So, almost $2,000 to $3,000 a year in difference. And so being able to surface that is really important. And, you hear about some of these poor experiences in particularly on the Medicare Advantage side. Part of that is driven by the fact that consumers can't see what they're comparing. They don't see what is out there. They aren't able to make the decision on and understand if they actually are moving into a plan with the lowest drug costs available to them.
So speaking of drugs and Medicare and high cost things, GLPs, right? Have you, I think we're kind of still in early innings on Medicare coverage. It looks like next year we'll probably see some more utilization across the program with some of the expanded indications. But anything you've seen on your side towards the end of last year on the GLP, you can't talk about healthcare without talking about them. So I would love your take and what you guys are seeing.
I mean, we're definitely seeing more beneficiaries coming to us for coverage of that, and I think they're starting to get that covered. Obviously, they're expensive drugs, so they do push people through to the various phases quite quickly. And so I think one thing people don't really realize, maybe their group coverage does cover it at a very decent amount, but right now, if you are moving through and trying to claim it on a regular basis, they are expensive, and the cap for the initial coverage is $5,030. So you actually move through that pretty quickly throughout the year. So from our perspective, we don't have obviously great view on how the plans and the manufacturers are sort of negotiating, the PBMs are negotiating those prices, but we definitely see it from our side that more consumers are aware of it, and they're actually coming in and asking for it. And I think the shock that a lot of them have is that you actually the cost halfway through the year just spikes.
No, that's interesting. I'll be interested to have this conversation with you like a year from now, right? As we have more of the indications and more Medicare coverage of them for for some of those specific indications. So how's it going? The business, the sector continues to grow at large, and I think we were chatting before about some recent growth milestones. So I'd love to hear, how things have gone for you guys.
Yeah, it's doing well. I mean, we, have always built this business on the view that we are serving this demographic that's aging in. 60 to 70% of our customers are 65 to 69, and we really believe that we're in the inflection point of this person who's turning 65 wanting a digital first experience. So that's only going to accelerate in our favor. And so we've seen sort of tremendous growth through AEP last year versus the year before. And what's really promising to us is the amount of activity that people are doing on our platform. 5 to 10 years ago, I think you would sort of really question whether people would give you their prescriptions or drugs or personal information online without too much of a prompt. But nowadays, I think it's just same for us, just seen as usual. And so that's really promising for us in terms of, okay, there is this world where there's an experience that is digital first that really caters to this demographic aging in, as well as, we've seen a lot of focus from employers on the caregiving side as well. And so we're seeing younger demographics who are also trying to make the decision for their parents, trying to find a solution. And we've heard it multiple times where they're going to Medicare.gov and it's just hard to understand, or there's no easy channel for them to find. So there's these tailwinds that are really working in our favor from that perspective.
Very cool. Very cool. And are there any, I guess I would say, demographics or, types of sections of the market that you've seen or been surprised that having more customers in that area, whether it's folks looking for, wraparound coverage or is it just people looking for their basic Medicare Advantage plan? I'd be kind of curious about what the kind of demographic you're attracting, what they're actually looking for, and who they are.
Yeah, we have a pretty widespread, actually, to be honest. I'd say we're kind of 50-50 down traditional Medicare versus Medicare Advantage in a lot of cases, and also serve people on the Medicaid side. A lot of that kind of comes down to probably where we're finding these customers at the moment. But as we build our channel partners, we may skew to one or the other. I mean, for us, the nice thing about our platform is it really does cater to each of those demographics, regardless. The decision tree of trying to figure out, is a supplement plan better for me, or staying on traditional Medicare or Medicare Advantage? It's actually really the same questions that you have to go through in order to make that decision.
Very good. So we're going to transition a bit to some of the policy landscape. And as I mentioned, earlier in April, CMS finalized a bunch of regulations on Medicare payments, as well as how the plans are marketed, specifically around kind of broker compensation. So I know you and I've talked about this before, but kind of to set the stage, set the table. Love to talk about how you guys think about yourselves relative to the traditional, kind of Medicare Advantage brokers that are out there, that I think have fallen under a bit of scrutiny, both from CMS, HHS, as well as from Congress.
Yeah, I mean, our real competitors really, well, I think the market's always to kind of take a step back, split into this kind of field agent world and the direct consumer world. We're kind of more on that direct consumer side. And what you've seen on the last, 10, 15 years is this kind of wave of call centers that have moved into the space. A lot of them selling other types of insurance in other verticals and moving in. And what they've brought along with them is this machine that works, really well from a conversion perspective in that sense, in that they have this one-touch call model, which works great if you're maybe buying an auto policy or home policy, but doesn't work that great if you're trying to buy a Medicare plan, because a lot of people actually need some time to consider what they're looking at. And there's a lot of kind of incentives built in that, may cause people in that space to suggest plans or enroll people into plans which may not be best for them. And it's hard, coming back to why we exist, it's hard for consumers to know that because they actually can't see what they're comparing. You are listening to the phone and trusting the person on the other side to make the right decision for you. In many cases, I think why the regulators are stepping up their regulation is because people are getting into the wrong plans. They are finding out their doctor is suddenly out of network, or the drug that they had covered at a low cost is now high. And it's also playing out in some of the numbers. There are public players out there, and the retention rate is not great if you think about where that is relative to maybe what it would be seen as more normal.
Got it. So just to get more in the weeds, so a number of the policies that they included here limit some of the brokerage compensation, and some of the fees there that some of these folks can get. I mean, just thoughts on what that means for you guys if you're kind of squeezing the compensation to those other players in the space.
Yeah, I mean, there's kind of a few ways to think about it. For us as a startup, it actually wasn't something that we were that worried about. We were never these kind of scale players getting these huge fees anyway. And so we always had to build our model off whatever the base compensation was that was available out there. And secondly, from a CoverRight platform perspective, we've always wanted to stay independent. So we never wanted to have any of those fees sort of influence what we're recommending, because our long-term vision is to have a multi-year relationship with this customer, not sort of a once and done, and we never talk to them again. What we're seeing though is there's been a pattern and history of, very smart, or maybe that's not the right way, or like uniquely structured incentives around administrative fees or volume-based incentives that have caused certain players in the market to maybe over promote certain plans versus other plans. And what CMS has basically done is said, we're not allowing any of that. I think they broadened the definition of what compensation is, and basically said it's now a flat fee for everyone within that world. And I think it's good and bad. It's a blunt instrument. Overall, I think it's probably positive consumers, given the negative behavior that's been happening, and it may also unfairly impact those who are doing the right thing. If you're fixing the cost structure completely, it doesn't mean some of these costs go away. And, I don't obviously have the full insight into how CMS came up with this extra $100 that they're talking about. But, there are real cost structures to contracting, to managing particularly on the field agent side, a whole set of field agents, the compliance and things like that. And, if it's not matched appropriately, maybe that is getting pushed down to the end field agent, who may actually be doing the right thing. They're doing right by their client. But now they're maybe impacted. The other thing I think that's happening there, Medicare Advantage carriers get better comp for better outcomes, better star ratings, and so there's probably a subset of players a small subset of players who unnecessarily drive most of the noise in terms of the bad behavior. And maybe should there be policies that help the players who are actually doing the right thing? I'm not sure what that would look like. Maybe it could be tied to retention rates and things like that. But overall, I think it's positive for consumer. I think there's a lot of unknown impacts of how it's going to play out for the industry. But I do think it may sort of negatively impact some of the people who are actually have been doing the right thing the whole time.
Right. So I think that sometimes happens in policymaking. And the interesting thing about Medicare Advantage, as we all know, is they do have an annual rulemaking cycle. And unlike other federal programs in Medicare, they've got a pretty wide kind of swath and authority to do things. So I think that maybe allows for tweaks and changes as we go on. But I think some of the broader trends that you mentioned are important. Is as the star ratings emphasize beneficiary experience. You're hoping that you'd want to head in this direction of making sure that it's a plan that you want to stick with and you want to minimize churn. But hopefully this does help take that some of the bad actors. And this has been a long running thing, so I don't think
Yeah.
it should be a surprise to folks.
And I think it will be interesting in how it plays out in terms of fostering competition amongst the plans, because I think one of the things that is said is that it will allow some of the smaller plans or regional plans out there to be more competitive. It may and it might not. Like what you probably might see is that a lot of that marketing spend then just goes straight back up to the parent corporation, who still has the ability to spend the money on branding and whatnot that these smaller players don't. So it might actually harm some of these small players who it may make sense for them to have more flexibility to market themselves, so you can have a more competitive market. We don't know. I mean, it's going to be hard to see. We'll see what happens, but that's kind of a few thoughts on sort of the positive and the negatives.
No, that's great, and I appreciate the balance there. I want to delve into that kind of big plan, small plan thing just a bit. So when you guys are building, CoverRight in your platform and trying to help folks find the right one, it's the diversity of plans is something that you guys are able to offer to folks as well, right? Because you're kind of agnostic, is what you said.
Yeah, exactly. Like our goal, obviously, like every private player, there are compliance things that you have to run through to actually get contracted with every carrier. But we've always taken the approach that we want to provide a proper marketplace. So, when we go to a market, our goal is to, represent 80-90% of the plans that are actually enrolled into or available in that area. And so we'll continue to do that. Unfortunately, sometimes you get to the point where it doesn't make sense for you and the carrier, because you have this contract that you're not sending any business to them. And that comes down to a more competitive competition thing on the plan side.
Got it. The other thing that I mentioned in those the Medicare regs that were finalized was kind of changes in rate payments for 2025. And now I think some of the public statements out of the large publicly traded players have indicated that the changes will result in impact on beneficiaries and benefits and things of that nature, more the supplemental benefits. Just kind of curious your thoughts. It's early innings and no one's really come out with even plan offerings yet for 2025, but any observations there are always interesting from kind of your seat, because you guys have such a wide swath or such a wide view into the benefits that are out there across the board.
Yeah, I think it actually ties a little bit into some of the other commentary about like supplemental usage and setting notices to consumers about whether the benefit's actually being used or how much is being used. And I think part of it is I think people will either cut back on benefits, or they may exit sort of more unprofitable plans in certain geographies. And so you may see some switches across different counties and geographies in terms of the plans that are available. But you may see some carriers be able to sort of manage that through maybe improved pricing they have from quality ratings or things like that. And so what we've seen generally is that 2021, 2022, like there's a huge wave of like these new supplemental benefits that came out. 1 year it's over the counter, next year it's like flex cards were the next big thing, and then there was healthy groceries was the next big thing after that. And I do think there was a bit of a over advertisement or of some of these benefits, which maybe weren't even being used anyway for the most part. Particularly, like the regulators are kind of seeing if that's the case. So you may see some of these benefits cut back. I don't know if it's actually going to impact too many people in the sense that some of those benefits weren't being used anyway. In some of these cases, I think the statistics 5 out of 10 don't use the over-the-counter, 9 out of 10 don't use the healthy grocery. So we'll see what actually happens, but I think some pressure on the carriers is a good thing. People, I think, when there's margin pressure, people tend to be more innovative about how they're managing the things that actually matter, medical expenses, things like that, and how they provide care and deliver healthcare in a way that actually removes some of these catastrophic insurance risks that relate to someone not doing all the preventive things that they should be doing.
I think that's very interesting and insightful, and we'll certainly see how that plays out. But I think your description of kind of the arc of the supplemental benefits is I think spot on, and we'll certainly see how as folks come with their plans and put them together for in the coming months for next year, how that plays out and how they do react, because certainly these rules are finalized and there's not much you can do until they start working on the rates for 26. Speaking of policymakers, and we talk a lot about negative things, would love for you if you had like a magic wand or just some ideas or asks for policymakers to help make this market a little more efficient. If your goal is to really create a marketplace where people can kind of get the best plan for them. What are some of the things you're seeing out there that would be helpful, or that you think would help people get to get that right plan selection, have that good customer experience when they're selecting their plans?
Yeah, I mean, I think the one that always comes to mind for me, and sort of having been in the space for a few years now, is obviously there's a lot of big players, and CMS, like you said, has to do what they have to do with some of the blunt instruments that they have. Something that no longer exists, there's probably various reasons for that on the CFPB side, is at some point the regulator there was basically working closely with innovation and had the sandbox that they were working with startups to allow them to test different types of disclosure to make it easier for consumers to understand. I think that's actually really an interesting idea. Today, the way the regulation works, it's actually very onerous for a startup to get in there and actually do the marketing, get the marketing compliance, just because of all the layers that keep getting added on every single year, and it changes. And one year you have to do this disclaimer, next you have to do this disclaimer. I think all of that stuff is great, but ultimately, sometimes doesn't actually get to the crux of the problem, which is the topic itself is hard to understand. And so you need sort of some to foster some innovation and allow for some new players to come in and go, okay, how do we do this in obviously a regulated manner? Maybe with an approval where maybe you're working directly with CMS, which is this kind of the CFPB idea sandbox where they'll give you this waiver, you work with them directly, get it approved. Maybe there's something like that could really help foster innovation, because while in many cases where we are actually all for a lot of these regulations, it's actually a tailwind for us, because when you're a startup and going, we're here to deliver transparency, none of these things, like while they have a burden on what we're doing, it actually doesn't impact us negatively because in the spirit of what we're doing, we're always trying to actually achieve the same outcome. But the ability to innovate more, faster, to deliver a better experience, that's kind of helpful, I think, for the world that we're in, at least.
It's an interesting concept, and certainly, again, we're back to that crossover of fintech and healthcare, and that's I think that the trialability is something that is, especially when it's health benefits, can be challenging, but it's an interesting idea, and certainly a good suggestion, because it fosters at least a culture of innovation. It's not asking for something a payment rate change, but hey, let's just have a conversation about what may or may not work, and if it doesn't, we can move on. If it does, then everyone's happy. So I like the creativity there. Before I let you go, and Richard, we love to end with a session called "What's Next." What's next for you guys? What's next for CoverRight? Kind of future plans the next 6 to 12 months, and where you see this thing going.
Yeah, our future plan obviously is continue to expand what we're doing today. We think the technology is really needed for people who are turning 65. It is a difficult conversation, and I think volatility in the market actually makes it more important for us to be around to help people navigate these changes, whether it's benefits changing for the positive or negative, or it is the carriers are making decisions on their side on networks and things that impact the consumer. So that's that. We're also still excited about a long-term vision, which is to really follow this customer through this decision point and actually help them activate benefits. And so I think we're very much in line with CMS's goal of improving usage of supplemental benefits. And one of the things that we're working on is how do we build this experience that is not just Medicare selection. We call it kind of post-enrollment. We're actually moving along with this customer to help them activate benefits in the plan that they otherwise wouldn't have used, direct them to the right services, be this kind of navigational partner, and also connect them to other things maybe slightly outside of the Medicare realm. We've partnered with companies like Mark Cuban Cost Plus Drugs and to ingest some of their information to help customers save, things like that.
That's great. And congrats on the partnership with Cost Plus. That's certainly got to be helpful as you're building things out in the space. Well, Richard, you mentioned being, wanting to help people navigate the benefits, and this is the Navigator Series podcast. So from one navigator to the other, thank you so much for your time today, and I look forward to keeping in touch.
Thanks for having me. Appreciate it. Thanks, Tommy.